pension fund investment meeting today. Today is 12/9/11. It is about 4 minutes after 10. We are at the New York City Controller's Office, 1 Center Street, room 530, New York, New York. Could we have a roll call, trustees, please?
Roll call of trustees. Ms. Ramji Nagaswamy.
Ms. Emery has Ms. Nagaswamy in proxy.
Mr. Thad McKee.
Here.
Janice Emery.
Here.
Mr. Stephen Cassidy.
Mr. Straub has Mr. Cassidy's proxy.
Mr. James Levin.
I think John has his proxy.
Hold on a second.
Mr. Robert Robb.
Here.
Mr. John Kelly. Mr. James McGowan.
Here.
Mr. John Dunn.
Here.
Mr. James Lamonda. Mr. Sean O'Connor. Commissioner Douglas White.
Here.
We have 19 and a half votes and a quorum. We can start a meeting.
Okay. First we're going to start the public agenda.
Start with Martin, Commissioner, if that's okay?
Martin, Dan.
Martin Yancel.
Martin will start, okay. Martin?
Yes, so the order that we're voting for the executive, for the public session is the order that you see here. We'll talk about September, overall different asset classes. We're going to talk about October, trade deal of November. We have the rebalancing range discussion that NBC will be talking to us about, and then we'll do the quarterly reports for the DSS. Okay with everyone? So the first thing, of course, is the quarterly report for September. Does anyone need an extra copy? This is for the full fire and quick.
I do.
That's a good thing for the So we've gone through the September quarter numbers and Larry over the last few months as we're going through August and September. So some of this information you've been seeing and hearing already in previous meetings, but we're showing you some more details this time around with the quarterly report. You'll remember the September quarter saw heightened market volatility and a number of serious economic and political concerns weighed on investors. The continuing concern over the sovereign debt crisis in Europe, the thought due to the weakening showing of many economic reports in the U.S. over possible slowdown in the U.S. If you remember back in July, this quarter, in July, early August, there was the very real possibility that the Treasury was going to default in the debt ceiling negotiations. And in fact, what happened was that S&P downgraded the U.S. debt. So we did see a very big shift out of risky assets during the quarter into risk-free assets. For the quarter, the U.S. market ended up down over 15% for the Russell 3000, which is our U.S. equity benchmark. Large cap did beat small cap, but again, still below what we would like to see was in double-digit negative returns. Non-U.S. equity markets were down more, as you might expect, since a good part of the concern had to do with Europe and the crisis. The MSCI EFA index was down 19%, and the emerging markets index was down more than 20%. And the flight to quality also extended to high-yield bonds, although not to the extent on the price level that we saw in equities. And high-yield bonds were down about 4%. Pretty much the only positive numbers you're going to see in this report are in fixed income. Fixed income, especially in investment-grade fixed income. investment-grade fixed income benefited from the flight to quality, specifically the flight to quality of the treasuries and agencies, which did very well in the quarter. Investment-grade fixed income also did well. Balance sheets are improving. Cash flow is doing well. Business in general is doing well, and we're running businesses to preserve capital in an uncertain time. Overall, though, if you turn to page 9, the presentation, you'll see the full quarterly results, and the results for the quarter are negative. Negative 994. While it was ahead of the policy benchmark, they are still strong negative numbers, and it was ahead by about 47 basis points. The one-year number for the trailing 12 months is still positive and ahead of the benchmark, and the longer-term periods are higher, but of course dragged down from the most recent quarter.
Let me just note that Mr. John Kelly is present in the meeting now, and you understand you have Mr. Slevins' proxy. Correct.
The next two pages show the asset allocation. Page 10 is showing the old policy weights. Page 11 shows the new policy weights. So the top part of the page, the pie chart that shows where the money is invested, is the same on both pages. And relative to what the policy is, for instance, under the old asset allocation, if you look at the very right on the bottom, we're underweight U.S. equity, but because we reduced U.S. equity in the new asset allocation, you'll notice when you turn the page on page 11, relative to the new policy weights, are actually overweight. A couple of points to note on page 11. Towards the left side, you'll see a light blue bar. That's hedge funds. So we have we made our initial hedge fund investment earlier this year. It says minus 4.3, and we'll be talking to you over the coming months about moving that down, that underweight down, and to invest to the policy weight. On the fixed income side, a couple of items to note. You see the pink, or at least I call it pink, bar that says minus 4%. You'll recall that policy changed from 1.5% to 5%, and the board, we were talking to the board about new potential investments that have been approved, and we are working very diligently on getting that money out, getting the contracts done. They're very complex, but by the end of December, we will see new investments that have been made in that area, so we are taking that down. The last item on this page, of course, is on the very right, which is the cash level over 9%, and I'll address that a little bit later as to how we've been bringing that down. Lastly, on this page, of course, the brackets that we're showing are rebalancing ranges. We're going to have a presentation in a public session in a little while about the new policies. So the brackets that you see here are likely to change just for comparison purposes. We use the old rebalancing range since the board has not approved yet new rebalancing range targets. But once the board approves it, we will then have those numbers updated accordingly. The next few pages go through the attribution of returns. And for the quarter ending September, which is shown on page 12, the results, of course, are negative. We were ahead of the benchmark by 47 basis points. The allocation effect, of course, is the result in performance due to being overweight or underweight versus the policy measurement effect is how the managers did versus their individual benchmarks. An important point to notice is that the positive allocation effect of 77 basis points was in large part due to the cash balance that we had, high cash balance in a down market, such as the September quarter. Cash helped. So cash did what it was supposed to do in the quarter. Now, while cash is a drag on performance in an up market, in a down market, it is a buffer. In fact, it is a very effective tail risk hedge, so it helped. We'll be talking again a little bit more about that. Now, having said that, later on we will be talking about redeploying and how we have already redeployed a good deal of that. Pages 13 and 14 show the 1-year and 3-year allocations. The 1-year had similar effects that you saw. The numbers are not particularly high because they were dragged down by the quarter, but are still positive, and the 3-year numbers sort of it sort of averages out what's happened over the last 3 years. And we'll note that the 3-year number ending September 30th is a very important milestone because as you're going to be seeing going forward, we're going to be further away. The next quarterly report, for instance, will be further away from the September quarter, which was, of course, September 08, during the wind crisis, which was particularly dreadful as far as performance goes. So you'll see some significantly different numbers that will be higher in those three-year numbers going forward. What's drawn your attention to pages 16 and 17, and that's how fire, dig versus other large public funds here is defined as greater than $1 billion. If you look at the quarter ending, that's all the way to the left. Fire minus 994 is in the 77th percentile, and this is part of what part of why we adopted the new asset allocation, and we'll take steps in the future as well. The 77th percentile is there because we have too much equity risk in the portfolio compared to a lot of the peers. We're attempting to take that down, and we will attempt to take that down further as legal constraints permit. For the year end in September, it was just below the median at 170. The next page shows annualized numbers, and you'll note in the middle of the page at the bottom, the 1, 3, 4, 5-year numbers are in the area of a little bit above, a little bit below median, but are driven by the end date of September, which was a quarter that were negative numbers affected by the high level of equity risk in the overall portfolio. Seema has some comments on the equity portfolio, starting on page 19, and I'll put it up there.
Thanks, Martin. So actually, if you just turn to page 20, start out with the domestic equity returns for fire in the quarter. And you can see we're a bit below the benchmark, which is the Russell 3000. And the next page really shows the breakout of that slight underperformance. If you turn to page 21, I'll point you to a couple columns here. The index return, and as Martin pointed out earlier on, the U.S. markets did not do very well in the quarter at all. The international market's doing a bit worse. But you'll see the actual return column right next to it and then the difference. And I'll just point out a few highlights for the quarter. There's small mid-cap active managers that you have outperformed by 150 basis points. And I just highlight Brown, which is one of your developing managers that had some good numbers in the quarter. If you go down a few more rows, you'll see the Russell 1000 active managers, which are your large cap managers, and underperforming by 370 basis points roughly. And that really is Zeffenbergen, one of your large cap managers who had a tough quarter, although their longer term numbers are still strong. And then your emerging managers, just in the last row there, just a bit behind the benchmark there overall. If you turn to page 28, that'll take you to the international allocation. And again, if you go to the columns index return and actual return, so as you can see, the index return down high double-digit numbers, particularly in emerging markets. And then relative, we've actually done well in the EFA value category. One-year manager Spruce Grove did quite well for you. And if you scroll down a couple more rows in the non-U.S. activist category down in relative terms, about 400 basis points. That's governance for owners, which had a tough quarter. They've had some good calendar years in the last few. It's been a short time that we've had money invested with them. But they're your activist and your only activist manager in EFA. You turn to the next page. It just shows you in aggregate how the EFA total portfolio has done relative to the index. And so these first set of bars here, the trailing 3 months, show that we're about 70 basis points behind the benchmark for the quarter. And then on the next page, you'll see emerging markets relative to the benchmark and really roughly in line with performance there relative to the benchmark. And now I'll turn it back to Martin.
So the summary of fixed income starts on page 34. And you'll see that $2.5 billion set for $2 billion valuation on September 30th was invested in fixed income. The slice is the green, which is the structure of the fixed income program. otherwise known as your investment grade core fixed income program. You'll see the purple, which is cash, and again, I'm repeating myself, but we'll get to that in a little while. The next page breaks down the core fixed income program, which was representing 18% of the overall fund, or $1.3 billion. Three major sectors are shown, and in the under and column, you'll see that we're underweight treasuries, overweight mortgages, and credit overweight equity spread product. In that quarter, because of the down quarter, that negatively contributed to performance that reversed itself in October and will go into a little bit later. But you'll see the return on the index actual return was remarkable, 13% return for treasuries and agencies. And don't shoot the messenger here, but when treasuries and agencies are returning 13% a quarter, that's not a good sign for the capital markets. And you'll see even investment-grade credit, while we don't have government guarantees for those, the reality is, though, most of those companies, and certainly the companies that are in the index and most of our managers own, are improving their balance sheets, are improving their financial position, they're extending out maturities, and so they will be rewarded by investors even during the flat policy. The returns, taking it all together on the next page, that's page 36, and for the quarter, we'll actually see some positive numbers, and for the quarter it was 412%, down behind the policy benchmark of 478. For the year, the return is 622, pretty much flat with the benchmark. And for the 3-year number, it's quite remarkable, of 985, also ahead of the benchmark. I also want to note on the bottom of the page, these 6 and 9% returns were achieved with a lot less volatility than you see in the equity markets. We're talking about 45% volatility of returns. Tips are shown on page 37. Tips are government. Tips are treasury inflation protected securities that are guaranteed by the government. Effectively, treasuries with an inflation component. They do not do as well as nominal treasuries, returning 4.92% versus the 13 that we saw for the nominal non-inflation securities. There has been a very big run-up in prices in tips, and that sort of slowed down during the quarter. Although if you look at the 12-month one-year return, the result is 940. Again, behind the benchmark, long-term numbers we go up to 6 years are slightly ahead of the benchmark, returning longer term for 6 years in the 6% range and 3 years in the 8% range. The managers, in particular, we have, as you know, a 25% passive allocation. That's pretty much on target. The active managers, BlackRock had underperformed for the early part of the period, and now it's coming back. PIMCO has underperformed. We have been in discussions with PIMCO about adjusting some of the guideline issues that restrict them. We are in what they call their low flexibility set of guidelines versus what they would prefer to do. So we're taking some minor improvement steps to allow them to do some things that they do for other accounts where they're ahead of the benchmark in the other accounts, but they're behind for us for that reason. So we'll also be extending those dialogues to other managers, given what's going on in the capital markets. For high yield was down on page 38. It's down for the quarter. Not as much as equity. There's obviously some equity sensitivity here, down over 4.5%, 37 basis points behind the benchmark. For the 12-month period, there's still positive numbers of 10.25. That's slightly ahead of the benchmark. The really good numbers go out further, over 11% for the 3-year number, over 150 basis points ahead of the benchmark. And you'll see the volatility numbers, achieving those numbers are in the low double digits, and in some cases longer term, below 10%. The most recent markets have seen greater volatility, and so that's increased the volatility overall. We know that we have a search and RFP outstanding for high yield, so we will be talking to the board in the coming months about the results of that search. Convertible bonds are on page 39. Since convertible bonds have much more equity sensitivity, our general rule of thumb is that it's about 70 over market cycle, about 70% of the upside. The way we built the program, about 70% of the upside of equities, with about 40% of the downside. For the quarter, it was minus 11% and change. That's shown in blue. Yellow was a worse negative number by 44 basis points. And an observation that we've noted, and certainly kind of in conversations with the managers, knowing what they're doing, and we've seen this when we started the program back in 2008, the managers in the program generally do much better when the market is not doing well. I'm talking about relative versus the benchmark, not on an absolute basis. And they don't seem to keep up with the benchmark, the overall benchmark, in strong bull markets, over market cycle is rolling out. And this quarter, again, is evidence of that. And finally, we have opportunistic fixed income on page 40. This is the area that we're going to be significantly increasing our exposures for the quarter. The results are minus 433. Benchmark, of course, is a flat 10%, so minus versus flat 10% would be on benchmark. The 1-year number and 3-year numbers are well ahead of the benchmark. And some of those numbers in 433, much like private equity and real estate, are lagged. Some are not. We're in the process of building a specialized report for you so that it will have a truer picture of what's going on with the IRRs in this program, just like we have for private equity or real estate. Unless you have any other questions, I'm going to turn it over to Kathy to talk about part of the investment program.
Hi, good morning. Your ETR portfolio is shown, and it's a fixed income mortgage portfolio, completely actually. While it underperformed for the shorter periods, it either outperformed its custom benchmark or was close for the longer periods, which is what we expect given the characteristics of benchmarks and UTI portfolio. So it's doing well. There is also a collateral benefits report in your board package, starting on page 7. There wasn't a lot of additional investments to show you in this quarter, but I did add a chart which I thought was really nice and you might want to see, which shows you the AFL-CIO Housing Investment Trust investments in New York City. You, of course, invest in the HIT. It's a nice visual. They've done a nice job. And we hope to actually work on a chart like this showing all your investments soon.
And of course, I just want to add, when we went into that investment, we went in with an understanding that they would be making additional investments in New York City, even though it's a national fund.
They have quite a nice pipeline, actually, and you should be seeing more.
So that's the overall quarterly report. Unless there are other questions, we'll move on to real estate and private equity.
Any questions? Okay, move on to real estate.
Good morning. The real estate report begins on page 17 of the board doc. The good news for domestic real estate is that we pretty much hit the trough, and real estate markets are stabilizing and coming out of it. Multifamily is leading the way. The office sector is definitely stabilizing, more because of lack of new supply as opposed to tremendous demand growth. Hopefully, as new jobs are created, that will spur some more demand. But as I said, the lack of tremendous new supply coming online is fortifying the vacancy, fortifying the markets, and vacancy rates are dropping across the country, primarily in the gateway cities. Another strong sector is industrial, specifically in the major port cities on the east and west coast. And the hotel markets are recovering very nicely. So we are optimistic that the funds will continue to recover, as we saw last year in fiscal 2011. We had a very good year for the 12-month period ending 6/30/2011. Your funds had a net return of 22.9%, significant rebounds of value in the portfolio, and we outperformed the benchmark, as you can see, by about 3.5%. The last quarter of the year, we did underperform the benchmark, but for the year, we were up. The big hole in the market continues to be the capital markets. The debt markets are tight. The CMBS market has not recovered as was expected. I think for 2011, the projections had been that we were going to see $50 billion of CMBS returning. It's been about half that mark. So until that market comes back, not a terrible thing because the flow of capital, I think, has limited the new supply, which has been helpful to the market recovery. The banks have been very restrained on the markets. The insurance companies have been the most active lenders. As we turn to page 3 of the report, page 19 in your book, you can see how the portfolio composition lays out. The allocation remains at 5%, about $400 million. We are about 45% core, 55% non-core and emerging. When you take market value plus the committed, we are at $289 million committed to date, which is almost 73% of the allocation, or 3.5% of the total plan assets. Flipping to the next page, looking at the portfolio compliance, we are below benchmark for the quarter, but the benchmark is a 5-year rolling benchmark. Most of our funds in this portfolio have only been in place less than 5 years, so we're still in a little bit of the catch-up phase. We're a little bit affected by J-curve, a little bit affected by the vintage, because the vintage of most of these funds were the worst part of the market cycle, and as the market corrects, it will be extremely accretive to the funds, and we should show great returns going forward. The correction should be extremely accretive to this particular portfolio of funds. We're a little bit out of sync in the 40-60 range, but again, some of that is the youth of the funds and the fact that the consultant recommendation had been for a little overweight to non-core, and we will be correcting that over time. We are currently funded at 2.3% funded, but committed at 3.6%. We are actively seeking to make that 5% target. We are, as you can see by the charts on page 5, in compliance with the diversification risks. The LTV benchmark of 50%, we are just above that at 53%. But again, part of that is the youth of the program. We are not fully invested, and some of that should come in line. And again, we are not overexposed to any one manager, and we can talk about that later. Barry, I think it's you.
Okay, so with that, I'm going to talk a little bit about private equity. It's page 26 in the big book. Thought what I would do, similar to the previous quarters, just touch a little bit about the market, and then drill down a little bit on the micro of the overall portfolio. So if we look at the private equity market for the second quarter, similar to the story we talked about in the first quarter, is that deal flow, deal activity remains strong. 674 deals completed during the second quarter, a value of roughly $76 billion, which is the highest level since the second quarter of 2008. And if we just put this kind of into perspective, 2008 was 713 deals and $80 billion. So really, back on pace to where we were in 2008. One of the things we've talked about before is deal size. So deals that were valued greater than $1 billion continues to grow. There were 21 deals in the second quarter compared to 13 in the previous quarter. That just gives you a little bit of flavor of what's going on there. With regard to fundraising, that's always a good barometer. Again, put it in perspective, 2011, it's been a pretty strong pace of fundraising. 2009, 2010, roughly $177 billion. 2011 first half, $141 billion. If you annualize that number, you're roughly $235. So again, picking up pace with that. Last thing is the IPO activity. That continues to grow, although clearly we've seen the third quarter slow down a little. But when we talk a little bit about the portfolio, and I'll give you a couple statistics there, you'll see that there's been an increase in distribution pace. If we now go down to the fire portfolio, as of quarter end, returns were 11.1%, so clearly moving in the right direction. The board, the trustees have done a great job with the portfolio. The portfolio today is a little bit more of a seasoned portfolio, so average age 5.3 years. So really getting into the maturation of the portfolio. Again, we've talked about numerous times J-curve, J-curve, J-curve. Well, now we're getting out of the J-curve. And as a result of that, start to see a big uptick in the returns. From an allocation standpoint, private equity allocation, there was an increase back in June of 2011 from 5 to 7% was the approved increase. On a pacing standpoint, that brings you kind of a nice wide range between 100 million and 200 million, so pretty wide range, but on pace to hit that pacing mark. And just by way of reference today, the portfolio is allocated 6.2%, so right in the middle of the range. From a benchmarking standpoint, on page 26, as I mentioned before, the portfolio is 11.1%. The public benchmark, the Russell 3000 plus 500 is 11.7. I think the takeaway from that is it's not something really to get exercised about at all, because one of the things that we've talked about private equity is a long-term asset class. And an annual, a 1-year return or a 2-year return or a 3-year return, the reality is it isn't a liquid asset class. So you really need to look at it more over the longer term. And as I'll touch on later in the presentation, you'll see that the delta, so the difference between the fire portfolio and the benchmark, really has come down tremendously. With regards to the comparison to a private equity benchmark, it's outpaced the private equity benchmark. We've talked a little bit before, should it be the median, should it be the upper quartile? It's getting harder and harder to benchmark versus a private equity portfolio as the fire portfolio just becomes more diversified. So you've got buyout, you've got venture, you've got distress, you've got energy. The benchmarks for venture economics and so forth are very focused benchmarks. So one of the things we're going to talk about actually in the first quarter of next year is possibly making a change in the IPS with the benchmarks. From a policy standpoint, right in line policy. So buyout target is 60 to 80%, right in the middle of that, 67%. Venture, which as we touched on before, we're not doing anymore. When we talk about the policy statement going forward, we'll just rebrand it growth in the 10 to 20% range. Distress and mezzanine right in the middle. A little bit out of balance on the kind of the catch-all bucket. But when we go through the IPS, we're actually going to define the catch-all bucket a little bit different, so you'll see exactly what you have as opposed to having 15 or 20% in a bucket that just says other. There's a little bit more of a challenge. By way of background, so if we look at it from a calendar year, 7 commitments, $145 million, many of them new commitments. Again, no performance to talk about because they're commitments just in the ground. A couple things I would touch on. So first quarter, just by way of reference, distributions outpaced contributions. And that was the first time that happened in probably a pretty long period of time. Good news is the second quarter, same thing. Distributions outpaced contributions. A little preview in the third quarter is it went the other way. But if we look at the beginning of the fourth quarter, we're now outpacing contributions again. So clearly moving in the right direction. If you look at on page 29, the overall portfolio, today 35% unfunded. So that means 65% funded. That number is going to get a little bit out of whack as the pacing increases. So there'll be more new commitments, more unfunded. But again, becoming a more seasoned portfolio, giving you a multiple today of 1.35, so moving in the right direction. Last couple things I would mention is if you look on page 32, this is what I touched on before, kind of the 1 year, the 3 year, the 5 year. I think the 1 year returns, yes, 22.7% is a great return, but you can't solidify that. You can't go out and get that today. So if you look at versus the benchmark, it underperformed by 15.4%, but that to me is not the number you should really focus on. I think the numbers you should focus on are either the 10-year number or the since inception number. So if you look at that, you're kind of plus or minus. You're either ahead of the benchmark a little on the 10-year, a little bit behind since inception, but in essence, you're moving in the right direction, and that gap has significantly narrowed, so I think that's important. Diversification standpoint, on the bottom of page 32, you'll see in the lower right-hand corner, North America, 76.1%, international, 23.9%. Again, moving to a more diversified portfolio, probably a 75-25 or a 65-35 is the right move, so clearly moving in that. Last comment I would make is page 33, which is the graph on the bottom. We've talked a little bit about the maturation of the portfolio. If you notice in the second quarter of 2011, and this is a comparison of the portfolio public versus private. Second quarter 2011, 85% private, 14.6 public. Now look at the second quarter 2010, 90% private, 5.7% public. So really what that's telling you is three things. One, the portfolio is participating in this exit market, and we've seen that by the distributions outpacing contributions. Two, as general partners start to take companies to market to sell them, in many cases they use the IPO market. It's an exit strategy. It takes them a little while to sell the shares. The portfolio should become more liquid and more public. And the third thing is, if you just look at the maturation of this portfolio, if you assume it takes 5 years to put the money in the ground, it takes you another 5 years to get the money out. This is roughly a 12-year-old portfolio that a lot of the money was put in kind of a 3, 4, 5. You would expect that there should be a larger public portfolio. So today, we're at 85 and 15. I think the expectation is going forward, you'll probably get to around 75-25. That is a much more mature private equity portfolio, so clearly moving in the right direction. And what's the most interesting about that is you just look over quarter, year over year, there was just an enormous move in the right direction. And if you see the returns, that's shown that as well. And with that, if there are any questions, I will leave it open. If not, that is private equity.
Any questions? Okay, let's move.
Okay, so the next agenda item would be October monthly performance review, which is in your book in black and white, but we have the color copies here. If anyone needs the color copies, we certainly have extras here. Okay. So, well, I gave some bad news for September. I personally apologize for the capital markets declining in September. We do have some good news to report about October. If you turn to the book on page 7, which is the unemployment rate, I just want to go over that. The concerns that I mentioned when we went through the quarterly report, and that Larry has been talking about each month going back quite a number of months, include the slowing of the U.S. economy, or the concern about the slowing of the U.S. economy combined with all the high unemployment levels and the European debt crisis. And the capital markets, in return, have been effectively risk on and risk off, sometimes week to week, sometimes a few weeks at a time, and sometimes day to day. But the fundamental problems remain. Unemployment declined recently from 9.0% on this page, as you'll see, to 8.6%. And while that sounds like an excellent move in the right direction, and it sounds very promising, it turns out that the decrease was due not because of people finding jobs, but was due because of more people being so discouraged, they're no longer counted by the government in the labor pool. When you include discouraged workers, workers who are underemployed or part-time workers, the unemployment rate is actually well into the teens. In fact, I believe it's in the mid to upper teens. And so this is a significant issue that even though the headline number went down to 8.6, is not necessarily the good news that you ordinarily would think of. The frustrating part of all of this is that all the episodes are constantly being painfully dragged out, especially in the European debt crisis. In Maine, partly due to the structure of the Eurozone itself and how rules for changes can be implemented. So it's just a painful process. Some weeks it's interesting that the markets have amnesia and focus on other factors, and next week they'll again focus on Italy bond yields being over 7%. That is not new news, but all of a sudden investors are focusing on that. So there's a lot of ups and downs, peaks and valleys, and volatility due to that. And it will take some time to resolve. So volatility is likely here for quite some time. If you turn to page 13, you'll see in the U.S. at least, one of the major issues is new housing starts. It's pretty much been a flat line at historical low levels, but going back now 3 years, and there's no indication that this is getting any better. There's still lots of foreclosures to go through, and obviously there are issues with the foreclosures that have happened to date, and that will simply elongate the process of getting housing back on its feet, and that is obviously weighing on investors' minds. Turn to page 20. Skipping around here. Obviously, it's been in the news about the euro debt crisis, so one would think that the euro currency versus the U.S. would be depreciating seriously due to the concern over the sovereign debt and the euro itself, whether it will survive. But if you notice, the euro, at least as of the date we printed this, was in the mid-130s, surprisingly strong in the face of that. So I just want to point out that if you look back when the low point on this chart was mid-2010, and if you remember what was going on in mid-2010, that's when the original Greek crisis first became a major issue in the capital markets. It's been an issue continually, and the euro went below 120. In fact, there were talk that it would go to parity, and then, of course, it rebounded. So this is somewhat puzzling, but there is certainly strength in the euro versus the dollar. The next page is the volatility index. We've been talking about this a lot. The volatility, of course, is a function of a lot of the uncertainty in the market. The good news, at least recently, is we've gone from the 30s and 40s range, which historically has been very, very as volatile as things get, at least until 2008, set a new standard. But the good news is we're now back into the 20s. So volatility has been tamped down a bit, but it's still there, and it's still a major concern. On the next page, on page 22, is the Treasury yield curve. The Fed is attempting through what is known as Operation Twist to lower longer rates. They obviously control short rates, which are effectively zero, but the longer rates are market-driven, and they're attempting to lower those longer rates. The most recent yield curve compared to the years that we have here, the most recent yield curve is shown in white, and what that effectively shows is that they have been generally successful in keeping rates low and even lowering those rates. Rates for 30 years have been hovering at 3. When there's flight to quality that goes below 3. And on the next page, you see the 10-year Treasury, which is bouncing around on either side of 2%, depending on whether the market is in, as I mentioned before, amnesia or fear. And right now, it's a little bit above 2%, or I think yesterday, a little bit under 2%, but it's pretty much been bouncing around there. The low during the panic in the summer was in the 70s for, again, 10-year Treasuries, when inflation, in fact, is running well above that. So your real return is, in fact, negative on Treasuries. The next page shows credit spreads on page 24. And in yellow, it shows high yield, and in orange or red, it shows investment grade. And in the flight to quality, obviously high yield has been hurt. Spreads went down as low as 442. And if you remember, we were talking about taking some high yield off the table and trying to sell high. When spreads go down, prices go up. So we tried taking some profits. In fact, we did. I'll get more specifics about the cash. And now that spreads have widened out quite a bit to 756, you actually have yields approaching, they're in the 9s and approaching 10% for the high yield market. I'm talking about performing loans. And the good news about high yield, while high yield, otherwise known as junk bonds, are in fact riskier than investment grade, while the market, the capital markets were open, many of these companies took advantage of, number one, refinancing their debt at lower rates, so they have the ability of what we call pay their interest coverage. And number two, they're simply improving their balance sheet because they're extending the debt maturities out. So the wall of maturities that you hear talked about has been pushed out for many years when the capital markets were open and functioning late last year, early this year. So much of the high yield market is actually in quite good shape. Companies are focused on preserving cash, improving cash flow, and their financial flexibility. And when rates actually rose and spreads increased, we did buy some high yield, as I'll talk about in a few moments. If you turn to page 29, you'll see how the global markets look over the past year. This is a chart over the 1-year period. And I want to draw your attention to the very right. You recall over the past year, and this is a simple line graph of returns, the U.S. market represented by the Russell 3000, the EFA index, which is in green, and the emerging market index, which is in red. The U.S. markets are actually up over the year, 3%, and non-U.S. is down in developed and emerging markets. If you look at the very right, you'll see that there's quite a dip. You'll recall the week of Thanksgiving in low volume, it was the worst week in the equity markets for Thanksgiving week since the 1930s. That was followed. That obviously was a case of risk off. The following week or the week after was the second best point gain the Dow Jones. Now, while we're not showing the Dow Jones here, you get the point. It was followed by the second best point gain in history in the Dow Jones Industrial Average. So that followed reports of some resolution of the European debt crisis or some framework of a resolution, as well as reports of Black Friday and Cyber Monday being above expectations, and that helped the stock market. So you see there's great volatility in the returns, and we go from concern and fear back to amnesia, back to what the real issues are. If you turn to page 31, you'll see the fire market values over a long-term period of 10 years. We ended October at 7.6 billion even. The high, if you turn to the next page, was in the past year. The next page shows the year, month by month, and the year was the high was just over 8 billion. The 7.6 billion was as of the end of October. We estimate that as of yesterday, the fire pension fund was about 7.5 billion. So now we're going to talk about cash, and the next two pages show the asset allocation in the same pie chart, but just moved up another month for October from September that we showed before. And you'll notice, on the cash side, we went from in the 9s, the high 9s, down to 7%. And what we've done, taking advantage of high yield, which we took down because prices were high, the market was open, so we were able to sell. Yields exploded, spreads widened, and so we bought back. So we estimate that by the end of December, the cash balance will be below 5%. In addition, we're also putting, as you know, we can talk more about specific investments in the executive session, but opportunistic fixed income. We're now finally getting some of the deals closed, and the money started going out this month. So in addition to opportunistic fixed income and high yield getting back to policy, we have hedge funds that we're going to be investing in, and that will take the cash down. So we estimate the cash will continue to come down from the 5% or below 5% that we estimate we'll see in December, and it will continue to drop as we invest in hedge funds, opportunistic fixed income, and emerging markets to get back to the policy that was adopted. Any questions on that or the cash? If you turn to page 37, I want to show you the really good news about October. You saw the dreadful numbers for September. If you look at the right, you'll see the 1-month number, and in the top set of columns, top set of rows, you'll see that the U.S. market was up anywhere from 11 to 15%. Small cap did best. Small cap trailed in September. Small cap led the way in October, so really good news there. The non-U.S. equity markets also did well, not quite as well. It was up 9 and change. Emerging markets were up 13 and change. And what that, of course, means for fixed income, once the risk trade was now back on, Treasury sold off, and the overall Core Plus 5 for October was roughly flat, positive 8 basis points, but the Treasury section of the Core Plus 5 is down nearly 2%. High yield, of course, has risk elements to it and was up a very healthy 5%, and convertible bonds were also up 5%. REITs, we talk about REITs sometimes, REITs were up a very strong 14.82 for October. I just handed out a piece of paper to show what happened in November, a preview of November, and November was roughly flat for the month. It was up for the month until the very last week that I mentioned before, the week of Thanksgiving. That was the worst week of Thanksgiving since back in the 30s, and that drew the numbers back down. So the numbers are roughly flat to slightly negative by less than 1%. Non-U.S. equity markets were down more because of course, the U.S., the non-U.S. and Euro issue, and the emerging market countries that are slowing down, Brazil, China, and some of the other emerging markets. And the Core Plus 5 was up, again, because of the risk-off trade. We'll have more information about November in next month's report. The next item I want to draw your attention to is on page 38, which summarizes what happened for the entire pension fund, broken down by categories. And if you look at the fifth category to the left, the fiscal year-to-date number is now down 3.77%. We did run numbers as of yesterday, and we estimate that as of yesterday, we're down about 4% for fiscal year to date. And the market value that we show here of 7.599, in other words, 7.6 billion, is about 7.5 Next is the summary of individual managers, and I'll turn it over to Sina to see if she has any comments on individual managers.
No, no.
Unless there are any questions for me, same story here. We want to point out we've been talking about high shields, so turn to page 45. When the market strongly rebounded, again, they're a defensive manager. Remember, they were outperforming when the market went down. This is we were describing to you because of their defensive nature and their higher quality bias. So in a very strong bull market where returns were over 5%, they underperformed. Again, we will be reevaluating the entire program in our search, and we'll be bringing that to you over the next couple of months. Are there any comments on the real estate and private equity? No. So that's our report, unless there are any questions.
Questions?
Okay, so the next item is the rebalancing range discussion, which has continued from the past few months, and Doug Mosley will start that.
Great. So back in the big board book on page 90 and 91, we have an updated memo and table to capture the adjusted proposed targets that reflect the feedback that you've given us over the last couple months. And just to recap, because the portfolio was going through a transition, we had started with a framework that had a lot of reference points to the past, and we've moved the portfolio through the last quarter or two more towards the new long-term strategic allocation, which is in the middle of page 90. And we've, with your feedback, adjusted the proposed target ranges to create more of a symmetric plus or minus, as opposed to some of the categories where we had no weighting, where we were saying we could go between essentially 0 and +2 or +3%. And so just reflecting that, a couple caveats here. The private markets allocations, private equity, real estate, and to a little bit lesser extent hedge funds, are allocations where the ranges, we can't physically rebalance. We don't have a lot of control over that. In the real estate side, you've got a little bit of liquidity. In the private equity side, you can do more long-term thinking and have a secondary sale like you've recently done. So the ranges here are really to trigger rebalancing discussions, to trigger the pacing discussions that you have with both your private equity consultants and real estate consultants on an annual basis. So that's what the guideposts are intended to do in that category. I understand that one or two of the other boards have adopted some language to kind of formally acknowledge that will likely be worked into the policy document, the actual written document.
So just to be clear, you're the second board that we hope to finalize this. The board that has adopted the policies finally was teachers, I believe, last week.
So if you look down under the ranges, you can see that we have ranges for each category, which are new for some of the categories. The old ranges are on the far right. So previously we had not had those range reference points for the private markets, and then the newer asset classes like hedge funds that were not part of the old policy, and the opportunistic fixed income, which was a much smaller percentage of the portfolio until the new target was adopted. Did not have ranges, and convertible bonds is the other category that did not have a range. And so the ranges for each category are intended to provide a framework for BAM when they're rebalancing the portfolio, funding new asset categories, so that they know that when we have, as Martin just went through the market summary, when you have those months where certain parts of the portfolio, REITs are a great example, they were up 13, 14, 15% in a month. You need to have a range around that to trigger taking money off the table when something just does well and putting money back into something when it does poorly, which is the discipline. And the whole point of having these guideposts and the targets and the ranges is really to try to take the emotion out of the process of moving your assets and maintaining your policy allocation. And certainly that's hard to do when we've gone through the last 3 years that we've had, and this year in particular. And so that's the discipline, is to help you keep you centered on that policy that you've spent time developing. And certainly we revisit the policy on a regular basis. I know in the past it's been kind of every 2 to 3 years, and now I think we've had a lot of conversations about it being more frequent and being every year. And so they're looking for approval for really specifically the ranges, because you've already approved the targets, so that we can move forward with the revising the investment policy document, which is the longer document that we use to manage and convey what the policies and practices are of this fund and the other retirement systems.
Do you want to make any comments on the parking places?
So the bottom of the memo talks about some of the newer categories, or the illiquid categories that are not fully funded yet. And specifically, we have opportunistic fixed income and hedge funds, which are the two categories that are the newer allocations. We've gone part of the way down the road of funding them. You're going to have some hedge fund managers in today, but the question becomes, if we can't put the money to work, by snapping our fingers or moving money within a month or a quarter, then where are the parking places, if you will, for the hedge fund assets, the opportunistic fixed income assets, and the other liquid categories that we're more familiar with? And so where would you spread the money out back across the liquid part of your portfolio, and really try to capture the risk, a balance of the risk of the category that you're trying to get into? Where, what is the risk profile of that category, and how can we capture it with the other asset classes? And so for opportunistic fixed income, the recommendation that we've made, and we've discussed it pretty extensively with BAM, and I know they've had conversations with the other consulting firms, with the other plans, has been to have 50% of that money, when it's waiting to be invested in the core plus 5 category, which is a lower risk category than this opportunistic fixed income, and 50% invested in enhanced yield, which is essentially a category that has a more similar risk and return profile to the opportunistic fixed income camp, and includes some of the exposures you're going to get with the managers you selected, like Fortress, Apollo, Marathon, etc. On the hedge fund side, I think we've had a lot of conversations when we went through the asset allocation discussion about the risk profile of hedge funds being somewhere between bonds and stocks. So For example, with a hedge fund portfolio you're constructing, when the equity market is down, you're going to typically expect the hedge fund portfolio to be down, half as much or even less than half as much as the equity market. But it does have equity sensitivity, and it also has exposure to fixed income assets and fixed income markets, either tactically or through using credit or even, being long and short credit. And so the balance we have recommended there is to have half coming from core plus 5 and half coming from domestic equities. Now, this decision today means more than it will in a year or 2 years, because right now, we've got a target that's almost completely unfunded, but you've already approved 6 managers?
4 opportunistic fixed.
4 opportunistic,
Yeah,
plus the existing.
The approvals are get us halfway there, and over the next few months, we'll be bringing more into and also an annual plan. So we would expect that by the end of 2012, we will be substantially there, at least on a policy basis.
Right, and so over the coming year or call it a year and a half till we get to that new target, this is where we're going to park that, 4 or 5% of the assets will be split half between bonds and half between stocks, which we think makes sense from a perspective of trying to capture the essence of that asset category. Although I would acknowledge that the 50-50 is probably a little lower expected return than we're shooting for with the structure of the opportunistic fixed income category.
I do want to address some of the mechanisms so you understand what we're doing. And it's similar to how we ran rebalancing or the adjusted policies before. So, for instance, if we're underweight private equity, the assets go into public equities. So right now the new policy in the asset allocation for U.S. equities is 29%. So suppose we were 2% underweight. Right now, the proposal is to have a plus or minus 6% range around that 29%. So if you go, so that really U.S. equity is 23 to 35%. If we were underweight a category that needed to increase U.S. equity by 2%, so the way we would adjust the policies would be that for the purposes of the range would be around the adjusted policy. So the policy is 29% plus 2% from other asset classes as a marketplace, plus or minus 6% would be around that adjusted policy. So it would be around that 31%. Just be clear. And that's the same as previously showed at Forbes. And that's how we've run the rebalancing program.
Yeah, so one of the other nuances is you have ranges around the total equity, total fixed. So if, for example, if you look across all the categories in equities, starting with REITs all the way down to hedge funds, because we have a cap on the group, we can't necessarily we can't be at the top of the range for all of them. We have to have kind of trade-offs, and we have liquidity in most of those categories, right, so we can move things back and forth. And the other key issue, candidly, to draw your attention to as trustees is the cash issue. We've gone through a transition period this year where cash has gotten higher, and Martin addressed that in the first part of the meeting. The range we're setting here is 0 to 5.
The policy would still be 0%.
Right. So the target is still 0, but there's typically always going to be some level of cash in the portfolio, typically below 1% when you've got cash coming in and out of the fund for benefit payments in particular. You have manager cash, which while we can set limits on and put policies around, is still going to be part of the portfolio. And then you have manager fundings and manager transitions that are typically taking place almost every quarter. And so the 0 to 5% range is really setting a max limit on where cash would be long term, and essentially saying, giving BAM a framework to operate in. Whereas if they want to go over that, they would need to come and seek your consent. And that's something that's a little different than the past practice.
Just note that Mr. Sliven is now present in the meeting, for the record. Janice?
So can we just talk about a little bit more about the cash? Because I think our current cash limit is actually 1%. I know you're saying that we don't have a limit today, but I think our current policy may have a 1% max.
Well, right, so the policy is 0 with 1% max. And what we're suggesting here is the policy is 0 with 5.
Yeah, and I just want to make sure that we're not kidding ourselves, that we have the ability to be market timers, so that we have all this foresight to say, oh yes, we think the markets are going to go down by year end, and are using this 5% limit to make market timing decisions.
Yeah, I don't think we've ever advocated market timing decisions, but I believe one of the things that we think is important is that when you have an asset, you know, sometimes it's smaller categories and sometimes it's the bigger buckets, where they have very strong performance in a short period of time, maybe a quarter or 6 months or a year, that's always going to trigger rebalancing discussions, and that always means it's going to be creeping up to the top of its range. And that frequently can trigger having more excess cash as you move money back into the other underweight categories. And frequently, you know, I talked about this design of this is to take away the emotion of it, but unfortunately, that's been a very hard thing to do in the last 3 years, because you've had periods where when the market shuts down on you, and as did in 08, and you can't either move money or it's very hard to put money to work. I think that means that while some of these ranges have increased because of the volatility in the markets have increased, that I think is the case for increasing the cash allocation range. It's not because you want to be a market timer and say, you know, we think this is way overvalued, we're going to take money out and we're going to put it into something else. Because the hard part of that decision, and sometimes it's easy to say something is overvalued and you already have a place to pull it back. But the harder part sometimes is saying, you know, what's more attractively valued than, say, when we set our policy and evaluated these asset classes formally the last time, and that's not what we're having.
I will say that I don't think Dan or anyone on this board is going to take a position for the long time. Right. Fully reflects that.
Well, and that's important, because the transition you're making on this portfolio is to reduce volatility and risk and exposure to the markets. And Seema and Martin made that point when they went through the third quarter report, is if we had this policy fully allocated going into the third quarter, and that first week of August where the market was either up 4% or down 4% every day, your fund would have probably likely performed, you know, 1 or 2 or 3% better in the down market than it had, because we haven't gotten all the equity risk off the table. And having a position in cash, while you can argue we're not good at market timing, is a default position to letting you reduce overall exposure or risk in the portfolio on the margin. So it's not giving anyone the ability to add more risk to the portfolio. It's actually saying, on the margin, if we're making decisions about moving money or rebalancing or repositioning managers, that we have a default position that is actually a lower risk than the policy that's in the middle of the page.
Even asset allocation works.
That's right.
So I would be comfortable with this so long as there was some language worked into the investment policy statement that incorporates what we just discussed.
Yeah, just to clarify for the record, two things. Was your comment just a minute ago about the default position for transitions? Historically, the default position, in a sense, ended up being domestic U.S. equity in anything that was risk-related, and usually core plus 5, I guess, if it wasn't. There's now parking places to move things to. And is it fair to assume that if there is a transition, that the overall risk profile of the policy would be the target for assigning the assets, or would it be related to the timing before you expect to move to something else? I mean, it's not a default position that when you say terminate a manager, it's automatically cash, is it?
No, I don't think it I hear what you're saying. It's not, we're not saying it's an automatic parking place. We're saying we have the flexibility to use it as a parking place, depending on all the other factors that we're trying to capture when we do a manager transition. For example, the cost of transitioning managers. Do we have a passive piece in place, or are we waiting to finish a selection of an active piece? And that's one of the reasons I think that Larry correctly, when he came on board, said we need to have some more pieces in the index puzzle so that we have flexibility, so we're not either sitting on our thumbs waiting to finish an RFP so then we can put the money to work, either to replace a manager we had to terminate because it was one of those conditions where you didn't want to wait, you had to cut the cord with a manager quickly. And so those are the types of things that are important. I think one of the things that we've talked about more informally is the idea that cash right now means essentially a very short-term money market vehicle that has kind of a duration of 90 days or less. And one of the things that may make sense is to have a bucket that's a short-term bond, an actively managed short-term bond account that has a duration that's half of what the Core Plus 5 portfolio is, but has a yield that's 3 or 4 times what the cash yield is today. So that's another piece that could add to flexibility. But you're absolutely right to point out the nuance of, we're not saying that cash is our default for anything that's going on in the portfolio. We're saying we can use it up to this limit when we are transitioning, when we're evaluating other factors. And it's not a market timing thing. It's all the things we got on the table, all the pieces that are moving, and the cost of moving the money. All those things factored in.
Now, as far as Janice's comment, I know Larry's not here, but we spoke beforehand, and he did want me to make this very clear that using the example of what we did in high yield, when we sold high yield, it was because on a historic basis, high yield had never traded at such low yields. And so it was an idea of moving money into what was an expected return that was here, and that now moving ahead, the expected return is much lower. So our view is that if the board wishes to address this particular issue in the IPS, it shouldn't be connected directly to this approval of the 0 to 5. It should be a separate discussion for the IPS. But if we did want to approve and are recommending approval of the 0 to 5 without the attachment or string that you're describing pending additional language in the IPS, we believe that's a separate discussion.
Yeah, again, to me, 5% is quite a wide range for an asset class that has a 0 strategic allocation. So I'm not sure that I would be comfortable with such a wide range if it didn't have some accompanying language with it to clarify what the purpose of the cash holding would be.
Well, I understand, and from our point of view, this would be the same as
I'm sorry, you said the same as what?
Same as what we adopted back in teacher.
And do you want to just talk about what we adopted in teachers, the language that we adopted?
The 0 to 5%.
But there was also an acknowledgement that any cash that was for purposes other than paying benefits or expenses, etc., would come to the board for prior approval.
Well, my recollection is that can confirm for me that the recommendation agencies coming with at teachers, the 0 to 5 was approved by consensus as presented.
Well, with the entire presentation, which contained some of this clarifying language.
My recollection of the meeting with the 0 to 5 was approved by the teacher system as presented. And along Martin's lines, what we'd like to do today is achieve approval of the bands that NBC and Doug has laid out, and we can have a conversation as to the IPS. But I think to attach the band question to the IPS is not a direction that we want to go in at this point. So to that end, please the board like to make a motion that we approve the bands that Doug and NBC laid out, what the Controller's Office agrees to this, and obviously we'll have, as others have indicated today, other discussions about our IPSs as we move forward.
Second motion.
Mr. Chairman, may I make a request before proceeding? There's one other item that I'd appreciate if Mr. Mosley could just confirm for the record. Under your second item on the parking places for real estate, you recommend the use of 50% core plus 5 and 50% domestic equities. Could you just clarify for the record why, when balancing between, we have like core real estate and non-core real estate, the use of the domestic equities rather than the REIT bucket, which already exists, as there, you obviously had a particular reason for not letting REITs be part of that balance. Was that a cost-related item or something else?
I'm sorry, there was some noise at the beginning of the presentation. So I couldn't hear the last few words.
Okay, I'll restate the question. The use of domestic equities as a parking place for the more volatile types of real estate rather than using REITs as a vehicle. And I guess my question was, for the record, is that because although REITs appear to have more characteristic of real estate than the average domestic equity, is the choice primarily one of the cost of transition, or are there other reasons?
Part of the issue is some of the retirement systems have a separate REIT allocation and some don't. So teachers and fire have a separate REIT allocation, and our feeling was adding a parking place for uninvested real estate that includes REITs significantly gives us, we're already at an overweight position in REITs. This gives us a much more significant overweight to REITs, which, as we pointed out in the quarterly report, does have lots of volatility, more than the real estate underlying that is supposed to be as a part of this.
That would seem to be more a question of rebalancing the REIT portfolio. I can understand across the multiple systems a consistent item, and if the reason for domestic equities is the high correlation to a lower cost available to everybody, kind of an alternative. But I just thought the record should be clear as to some of the reasons for excluding the REITs.
It wasn't excluded. It was discussed, and I think what you just described captured it. But I'd also add that the REITs, if you think of them, are acting right now. They've exhibited more volatility than the domestic equity market in different periods. I.e., there's been 6 or 8 months in the last 2 or 3 years where REITs have been up more or down more than 10% in a month.
And as far as overall volatility, we're talking about in the 30s to even 40% range.
Right. So it's like investing in one sector of the domestic equity market, and that's probably not a good trade-off in our minds for the real estate allocation, which, as you pointed out, we have two parts to that, right? We have the kind of the boring core part that is more like a bond with a little bit of equity upside that's more attractive, and then you have the opportunistic part of it, which is the juice in the real estate portfolio. And so I think you could make a case either way, but we were more comfortable with using the domestic equity category. In my mind, the real estate allocation is always going to be plus or minus 2% to your long-term target. So we're talking about 1 extra percent in core plus 5 and 1 extra percent in the domestic equity market at extremes, and that's still subject to the other ranges.
That's fine. I just thought in the future, if one looks at this, there might be a question that's just nice to have on the record.
Well, yeah, if you look back at the last month's board package, we had started out with that discussion about it being half full REITs. So, thank you.
Mr. Chairman, we have a motion on the floor.
Janice has a question. Do you have a problem?
Yeah, I just still think that this 5% is too high, but I would be willing to approve it without accompanying language if it were total cash in the portfolio. So right now I think Martin remarked that the way you're reporting cash to the board doesn't actually reflect the total cash in the funds.
This is cash that's set aside in segregated accounts, and it's not individual manager cash that they have in their individual accounts.
Yeah, I'd be willing to approve this if we make it clear that this is the total exposure of the fund to cash versus just this piece that's in the short-term investment fund that you've been reporting. Is that acceptable?
That was not our understanding when we spoke about it.
Because, again, 5% could actually be even higher because you're not reporting to us the full
So
cash
let me give you an
expense.
example. So in the extreme example too.
Yeah.
So in the U.S. government sector of the portfolio, which is approximately 20% or so of the overall corpus value, so 20% of 20%. The guidelines do not restrict cash at all. So what prevents a manager from having a all-cash portfolio? It's the duration restriction. We view cash in that context in the spectrum of risk-free investments that are available for them. So there are a lot of governments, treasuries, agencies, and cash. What would prevent a manager from being 100% cash would be the need to be within the limitation or the guideline rule that they can't be too far away from the index on a duration basis. Cash, of course, has either zero or near zero duration. So cash on a manager level, in many cases, are strategic to the individual strategies for the individual managers and are not really the same as what we're talking about here for we just have a pile of assets that's sitting aside separate and apart from a particular strategy.
No, I understand that, and that's why I'm even more concerned when I see in September 10% cash level, which doesn't even take into account the cash that the managers have.
Right, and so using that example, we would look at the cash, if you were to include the cash in those underlying portfolios, that those cash levels are actually part of their strategy to achieve their returns and their objectives.
But it affects the overall risk of the total fund, nonetheless, no matter what the purpose. So I'm okay either with the 0 to 5, with some language in the IPS, or 0 to 5 if we take into account total cash in the fund.
What I'd like to suggest is there's no way that we could always, the aggregate will represent that. So what I'd like to suggest is what I've suggested previously, that is to say to adopt the proposal on page 90 of NPC's presentation with a commitment that we will address this, as we talked to the board previously, in the IPS in the coming months. So that's the motion would be to adopt the information on page 90 and then obviously address the cash issue in the IPS as we've told the board in the coming months.
So we got a motion and we have a second. Are there any objections? Hearing none, the motion carries.
And we'll discuss this within the IPS. Thank you.
That ends the fire department pension fund public session, but we have VSF.
Well, we need a motion to move out of the public session.
Martin, can I ask you a question? You want to read the recess?
Yeah, we need a motion to move out of this public session into the firefighter variable supplement. I think that we need to have a roll call. I guess Janice Emery.
Present?
Dan McTee.
Present. James
Slevin. Present. Robert Strong.
Present.
We have a quorum. So, I guess the performance review?
Yes, we're starting with firefighters.
Yeah, we're starting with firefighters.
Does, do you have, which we have extras? How many? Which one? You guys have it?
We have a firefighter there or something.
Okay.
On this one?
Martin? Can I have one too? Thank you.
Okay, so if you turn to page 3, you already heard the comments on the September quarter. It was a dreadful quarter overall. There were a lot of uncertainties in the capital markets due to lots of different factors in the U.S. as well as in Europe. On page 3, we show the total returns for the fund. The fund was exactly $400 million as of September 30th. The fund returned 1138, which was 54 basis points behind the policy benchmark, roughly flat for the year, returning 23 basis points just behind the benchmark, and just ahead of the benchmark with a 3-year number returning 464. And you see the longer-term results as well. The volatility, of course, in the more recent periods has been increased, but on a longer-term basis are generally in the 11 to 12% range. I also want to bring up that there's a yearly payment that's due December 15th. While we don't have the exact number, we have a preliminary number of about $55 million, and we are having no problem at all meeting that obligation with the asset allocation presently, so no need to be concerned about the need to change the asset allocation. We're effectively doing pro rata, given the market cycles and where we are in the individual asset classes. We'll have next month for you what the exact number was, but it's roughly 55. I'm sorry, you guys. It's roughly 55.
Sorry, where is that payment going to come out of?
It's going to be pro rata across all asset classes. I do want to point out that we are at a point, and we talked about this last year, where some of these separate accounts, such as REITs, are at a point where it's difficult to invest a separate account with the level of assets. So what we're doing with REITs, as you know, we just went through an RFP process. The particular manager that we have here, which is Morgan Stanley, what we're doing is we're creating a commingled fund vehicle with the larger fire pension fund, so that small account will not be an issue at all going forward. And we do not anticipate having, given the history and our expectations of the liabilities and the payments going forward in the next few years for the next few December 15th, we do not anticipate an issue at all for the asset allocation on page 4 shows where the assets were invested. You'll notice the chart is a lot less busy than the overall fire pension fund, and that's because of the need for yearly benefits that are a relatively high percentage of the fund is invested only in public markets and does not have private market investments. As you can see in the overweights and underweights, we were underweight equity, in particular in yellow we were underweight the EFA markets, and we were overweight domestic fixed income, the core plus 5. We also have a cash balance. We talked about in the fire pension fund that was approaching, it was in the 9s, and we talked about the plan to reduce it. The cash balance here is generally kept low. It was, as of September 30th, $10 million, which came out to about 2.8%. All of that cash will be drawn down entirely to use to help pay the benefit. The attribution of returns are starting on page 5. It goes to 6 and 7, and then summary on page 8. Again, just like the fire pension fund, it was that quarter, negative numbers. Allocation effect was roughly flat, and we had some managers who underperformed. So the total underperformance was 54 basis points for the quarter. For the year, it smoothed out a little bit. It was minus 21 basis points, but we do have positive numbers. It's hard to tell because of the scale here, but for the year, the return was only a positive 23 basis points. So we were behind by 21 basis points. So effectively roughly flat for the quarter. 3 years a little bit better, and as I mentioned to you in the previous larger fund, the 3-year number going forward will no longer have this September quarter, which was, of course, the agreement quarter where things went completely. And the number is positive at 464, and we have a slightly positive effect for allocation and for management in both cases. And of course, we have the summary on page 8. This fund is invested in equity. The policy is 70%. We were at 67% as of September 30th, or $269 million. 3/4 of the fund was invested in domestic equity, and if you turn the page, you'll see that That comes out to $196 million, or just about half the entire fund. The fund is entirely passively managed for U.S. equity. So this is a Russell 3000 passive account. We do not have active managers in this particular fund for U.S. equity. And as expected, the fund returns were right on top of the Russell 3000. Going out to 5 years, actually going out to 10 years, it was 2 or 3 basis points. The volatility, of course, was in line with market volatility as well. It was longer term, mid-teens, and more recently more volatile, low 20s. In the EFA markets, we do have active management here. It's a single manager, Thornburg. It's 11% of the fund. We're underweight. The returns were minus 20.99, which was behind the benchmark, and for the year was minus 9.29, roughly flat with the benchmark. We were ahead for the 3 years and some of the other long-term numbers. So Thornburg had underperformed recently and has been outperforming the longer term. And emerging markets, we have one manager as well. That's on the next page, page 13. We have State Street. It's 4% of the allocation. As we discussed before, emerging markets had negative returns worse than developed markets, and the returns were minus 23.26, 80 basis points behind the benchmark. And for 3 and 5 years, we're also behind the benchmark. And you can see volatility on the bottom was quite high at 30%. The good news here for emerging markets and the EFA markets is that these accounts are already commingled. So when it comes time for the large benefit payment that's due December 15th, it's a relatively easy exercise to redeem because it's part of a much larger pool, if not separate. It's a New York only settlement. REITs is Morgan Stanley, and for the quarter they underperformed. The result was minus 16.13. When we get to October, you'll see they did much better. But longer term, as you can tell, the results are well ahead of the benchmark. And we go back as far as 6 years, and the return is positive 3.54, but that's over 200 basis points ahead of the benchmark. But you see, we just discussed this a moment ago, volatility is about as high as it gets in the public markets, in the 30s and even 40% range. That's the equity portfolio. Fixed income is a simplified version compared to the fire pension fund, again, all public markets. Page 16 lays it out. In green is our 4+5 core investment grade fixed income. The total of all fixed income was $129 million. You see in purple, I'm sorry, not purple, you see in yellow or orange, the short term, which is the cash, that will be drawn down to help pay back this, and that's obviously very easy to do. The breakdown of the 4+5 is on page 17. You'll see the over and under weights is similar to the other systems, including the larger fire pension fund in underweight treasuries, overweight spread product. Unfortunately, in this case, all 3 of the managers underperformed for the quarter, and the allocation effect hurt because treasury agencies returned over 13%, and we were underweight that. That reversed in October. The returns put together on page 18, take everything together, and the returns were a positive number. Again, most numbers are negative because of the distress in the capital markets. The return was 405. This represents 21% of the fund, or $85 million. The returns for the year were roughly flat with the benchmark, but a positive 631, and we had very strong returns for 3 years at 978, ahead of the benchmark by over 50 basis points. And again, as I remarked during the fire report, this is done with 4 to 5% volatility. TIPS, we have a separate account. This is commingled already. This is a PIMCO account. And while the returns were ahead of the benchmark and positive on an absolute basis for the quarter, they were behind for the year. And as I mentioned to you, we're in discussions with PIMCO because they have most of their accounts which are actually ahead of the benchmark. It's our restrictions that are causing this to be behind, and so we've been in discussions to prudently, where we believe it's appropriate, allow PIMCO some flexibility so that they can have more levers to pull for alpha. High yield is single manager, it's Sykes. They underperformed for the quarter by about 100 basis points. The return was minus 525. The year was 271, slightly behind the benchmark, but longer term was ahead of the benchmark, and the returns for 3 years were quite high on a relative basis, at over 10%. And you'll note that we achieve these returns with, on a longer-term basis, roughly 10% volatility. More recently, volatility has increased, but still low teens, so much lower than equities. Unless there are any questions, this is the report.
Yeah, Martin, I have one question. This is September 30th report.
Yes.
How much is in this fund as of November 30th?
So,
is there a major difference? Or?
well, October was a very good month, so let me give you, but then November, I'm sorry, we have October. November was slightly negative, and December to date is roughly flat, so I can give you this.
Okay.
So I believe, as of October, I don't believe, as of October, the number, remember, was exactly 400 million. As of September, as of October, was up to 433. It was probably slightly down from there, so we're probably in the 425 range as of today.
All right, because of the payout, I wanted to know
After the payout,
where we
would
stand.
be 55 million, so it would be 425 minus the 50.
Right. Okay, thanks.
Any other questions? Okay, then we need a motion to adjourn the firefighter variable supplement part of the meeting.
Motion to adjourn.
I'll second.
Any objections? Hearing none, the motion carries. So now we'll start the fire office variable supplement fund, and the roll call is Janice Emery,
Here.
Thad McTee, here. James McGowan, here. John Dunn. Here. So we have a quorum. We can start the meeting. Performance review.
Now we'll be addressing the correct side in this case. Does everyone have a copy of this? So in terms of page 3, the fund was valued at, on September 30th at 249 million, just like the question that just came in on the firefighter side. I can tell you what the value is as of October, if you'd like to know. For fire officers, the value as of October was 207 million. 270. Right. Right. Now, your benefit is paid as of the end of January, so we'll talk about that later. We'll have a more reasonable estimate as to what the benefit payment is, but it's less than 55 million. It's sort of, I think, if I remember correctly, it's in the 25 million. But we'll have to check. Bob may recall, but we will certainly update you next month on this. So similar to the other larger fund and the firefighters VSF, you'll see the total returns on page 3, and they are very similar where they have negative overall absolute returns. In this case, mine's 1179. This was 95 basis points behind the benchmark. Now for the 1 year, roughly flat at minus 26 basis points, also behind the benchmark of positive 44. When you go out to 3 years, we have positive numbers finally, and that's 476, and that was over 50 basis points ahead. The volatility was in low double-digit rate. Page 4 is the asset allocation mix. It's a lot more simplified as I described before. Similar to firefighters, fire officers is invested only in public markets. We were underweight equity. Most specifically, we were underweight the EFA markets. The cash value, because we talk about cash, in your case, was 2.2% or $5 million. That $5 million will be used to help pay the benefit. And we expect the benefit payment will not be an issue to deal with. And similar to firefighters, we believe unless capital markets change drastically or liabilities change drastically, there's quite a number of years to go before we have a conversation about changing the asset allocation. Pages 5 through 8 talk about attribution. So I mentioned the negative numbers. You see that on page 5 for the quarter. We were behind by 95 basis points. Most of that was underperformance by managers. The allocation effect was a slight 11 basis points. For the 1 year number, the total was a negative 70 basis points. Similar story, mostly managers, and it was mostly from the non-US equity portfolio. We'll get to that in a moment. 3 years smoothed out some numbers. The good news is they're positive. Returns on an absolute basis for the fund were 476, 57 basis points ahead of the policy, and both the allocation effect and the management effect were positive. So the managers who underperformed in the recent quarter have outperformed over the last 3 years when you take into account those positives. and the summary is on page 6. We'll go through these in a few minutes. So just like with firefighters, the fire officers CSF has a 70% equity policy weight and 30% fixed income. On page 10, we show the total equity allocation, which was slightly underweight at 68%. The green shows domestic equity, U.S. equity, which is 3/4 of the fund. And if you turn the page, you'll see the returns there. Just like firefighters, this is entirely passively managed and is exactly half of the fund. That's by policy, and that's where we are. Actually, slightly below policy by about 1%. And the good news is the passive portfolio performed as we would have liked, which is matching the benchmark for risk and return characteristics. You'll also remember a couple of years ago we changed from S&P 500 to Russell 3000, so the longer-term results are a blended benchmark of that S&P 500 Russell. But presently it's Russell 3000. The EFA markets are on page 12. It's single manager Philadelphia, which underperformed in the quarter. The result was minus 23%. Benchmark was also dreadful, minus 19%. Good news is we have better numbers in October. For the 1 year, the results were minus 12%, and the benchmark was minus 9%. But as you see, the 3-year number smooths out. In fact, the manager Philadelphia was ahead of the benchmark by 78 basis points, although the returns were roughly flat. You have to go back much longer to find positive numbers, and that's unfortunately the capital markets in EFA. They have been very volatile and negative. Emerging markets, since the inception of the program, we do have positive absolute results, but negative versus the benchmark, and State Street is the manager here. For the quarter, it was minus 23%, trailing the benchmark by 81 basis points, and that's why you saw the negative management effect in the attribution page. We also have a REIT portfolio. This is run by Morgan Stanley. They've done a very good job long term. You'll see for the 1 year out to inception, which is 6 years, they've outperformed by 150 basis points to over 200 basis points. Last quarter was a difficult one for them. On an absolute basis, returning negative 16%. October was much better. This was over 100 basis points behind the benchmark. And for the year, the return was roughly flat at 13 basis points, 150 basis points behind. But as I mentioned, they have a very good record longer term. And we will be co-mingling this account because, as you see, while it's 4% of the fund, it's only $10 million. It's very difficult to run a full portfolio, separate account, at such small levels. So we're commingling it with the Northern Fire Fund. Fixed income starts on page 16. This was $78 million, or approximately 31% of the fund. The largest allocation at 69% was for fixed income in the investment grade program. We did have cash at 5% of fixed income, and as I mentioned before, that will go to help pay the debt. Breaking down the core fixed income program by its 3 sectors is shown on page 17. Like the other systems, we will underweight governments and we will overweight the spread sector, although in this case credit we were slightly underweight. We're going to be true-upping this number with the benefit payments. We underperformed for 2 of the sectors. The mortgage manager outperformed, I believe the mortgage manager was BlackRock. And of course, the government sector returned over 13% because we were underweight. That led to a negative allocation effect that did reverse in October. Taking it all together on page 18 shows a total of 4 plus 5 results. 21% of the fund, $53 million. The results were 3.90, which were 88 basis points behind. For the year was 607, 18 basis points behind. I have good news for you for the 3-year number. It was 1042, and I believe that's the highest number that we have across systems for the 3-year number. Part of the reason for that is because you only need a single manager for each of the sectors. We picked the best manager. So you didn't have to go deeper down into the well. And also going down further, we outperformed modestly but in line with expectations. And again, the results of volatility were in the 4 to 5% range. TIPS are run by PISCO, and as I mentioned, to the firefighter group, the portfolio was ahead for the quarter, returning 467, a positive number, not as strong as nominal treasuries, but still positive. For the year, was behind, returning 876 versus 987, so behind by 111 basis points. This is a commingled account, so again, even though it's only $8 million, it's commingled with larger funds, so it's no issue at all to make redemptions because of the commingled manner. And again, as I mentioned to when we went through the firefighters version for fire officers, we are talking to PIMCO about some slight guideline, reasonable guideline, improved guideline changes to make it more levers to pull on an alpha basis instead of restricting it as we have. Last page that we have is high yield on page 20. As you know, we're going through a search process. The manager here is Sykes. They're a defensive manager. For the quarter, they underperformed by 91 basis points, returning negative 509. For the year, it was positive on an absolute basis, 306, roughly flat with the benchmark, and longer term, ahead of the benchmark nicely. You see the 3-year number was 1039, and that was obviously a very good return for high yield, fully recovering from the downturn. And this was achieved on volatility of low double digits. Are there any questions on high yield? We'll have next month more information about what the benefit payment was, but it's expected to be roughly pro rata across the system, so the acceleration will not need to be.
625.
I believe that's my recollection of the estimate. We have not gotten the official numbers from the Fire Pension Fund, the accounts of the Fire Pension Fund, because it's January 31st, but we're working. We have very good numbers going back 10 years looking at trends, and assuming the trends hold, we're in good shape. And I believe it's roughly 25. I'll confirm that for you at the next meeting.
Thank you. Thanks, Tom. Any other questions? We need a motion to adjourn the Fire Officers Variable Supplement Fund.
So moved.
Is a second?
Second.
Any objections? Hearing none, the motion carries. We need a motion to resume the Fire Department's pension fund meeting.
So moved.
Second? Second. Any objections? Hearing none, the motion carries. I think the roll call will remain the same. Well, maybe not, but then we just take that on the record, I suppose. We need to call the roll.
No, we don't need to call, we just mentioned Larry Schloss and James Levin and John Kelly are all here.
Yeah. Okay, so I would suggest that why don't we just make a motion to move into executive session first. Have a motion?
So moved.
Second.
Any objections? Hearing none, the motion carries. So we're in executive session.